Sandhar Technologies. The other one was Sandhar Construction. Let's take a look at what each of these, IPOs are doing right now, the ones which are listed today. So Sandhar Technologies is up as much as 3.4%, and it's had a reasonably okay listing. Sandhar Construction, on the other hand, has seen some amount of weakness coming in. It's declined by as much as 22%. So moving on, addressing Sandhar, it's come in, the issue price at around 5, and it's raised about 512 crores. This is the initial public offering, and subscribed as much as 6 times, a little over on the final day of bidding day. We have Ridhima Saxena, who caught up with the co-chairman and managing director Jayant Davar to discuss the company's growth outlook and also how they plan to deploy the IPO funds. Here's a slide of that conversation. Listen in.
We have 79 OEMs. We have 40 plants. We will have 40 plants by the end of the year. We have 29 product categories leading up to thousands of components that we manufacture now. Today, 5 of our plants give us about 65% of the, 5 of our clients give us 65% of the revenue. But like I said, there are 79 who are in the pipeline. And with each of them to mature, that's the future and process that we're looking at. We are very, very well diversified, not only in terms of product lines, but in terms of geographies, in terms of the automotive sectors, in terms of whether it's 2-wheelers or 3-wheelers or 4-wheelers or tractors or construction equipment or off-highway, what have you. So to us, at this point of time when the economy is doing well, especially in the auto sector, we have all our guns firing, and I see no reason why there should be any kind of a dilution of growth as we go forward.
So you had indicated in your expansion plans that you would be commissioning 5 new plants in India. Help us understand where that process stands right now, and how much of investment would be debt financed versus internal accruals for these expansion plans?
Well, one of the core reasons for us to go for this listing or the public issue was to retire the debt that we had on our books. We had about 500 crores of debt, out of which 250 crores is working capitals, and that also largely for our overseas operations where the cost of funding is much lower. But the term lending, which was about 250 crores, will be wiped out completely. We will work on a clean slate, and we have a caveat within ourselves that for the next few years, our investments will not exceed our level of depreciation. So a large part of the investment has already been plugged into the new plants that we are talking about. At the time of filing of our DRHP, we had 8 plants that were to go under commissioning. 3 of them have already been commissioned and have started operations. 5 are in the pipeline, which should be up and running before the end of the year. That's the plan.
So how much of the investment has already gone in? What will be the capex that will be required?
We have already spent over close to 650, a little over that crores. The incremental one is very, very small. But like I said, I've given you a caveat and a qualification that in the next few years, we don't see that exceeding our level of depreciation, which is at about 60-65 crores a year.
Correct. So your debt to equity comes to 0.4 after this listing. So going forward, would you be able to maintain that ratio, considering there are major expansion plans happening? And also adding to that question, going forward, what would then be the focus areas, since you're already very much present in 2-wheeler locks and rear view mirrors?
Yeah. Well, a large part of our investments, which have yet to build revenue, are in the new areas that come out of government mandates, whether it's emission norms, where we are doing our fuel pumps, new air filters, oil filters, so that's one portion of it. The other portion of it goes into our foray into auto electronics in a large sector. So we are looking at rear parking sensors, we are looking at tire pressure monitors, we are looking at AVN assemblies that we've just started. Those are areas which we believe are the futuristic areas. And we are pursuing that. So besides doing what we are already doing, where we are obviously, where again we are growing higher than the rate of the industry on account of new innovations that we are bringing into our existing products, we see that to be one area, and the new investments in the new areas that I spoke about, bringing in a separate stream of growth, which will obviously mean that the company as a whole would be able to move much faster.
On debt to equity?
On debt to equity, we are at 0.4. Like I said, the term loan debt is going to be cleaned out completely. With that happening, we'll only basically be looking to have a working capital. In India, our working capital cycle is actually negative. It's only our overseas operations that require working capital. And there again, at lower rates of interest from the international markets, which is serviced from there, we expect that our debt equity ratios will be very, very comfortable.